Alright, what's going on everybody? So today we're going to be talking about a very important concept in technical analysis, which is gaps. This type of phenomenon doesn't really occur very much in the whole crypto or commodity space because those markets are continuous, because trading isn't ever really paused. However, it is to be noted that gaps can occur during normal market trading hours if, say for instance, a game-changing piece of news was to drop, causing a major supply and demand imbalance, leading to liquidity on one side of the equation drying up. It's really rare, but I've seen this happen with things such as IPOs, when stocks get halted intraday, or on things such as crazy extreme meme frenzies. In any case, what I want to do in this video is go over 5 different important gap patterns to learn in technical analysis, one by one, and talk about how we trade every single one of these gaps and what it means. So without further ado, let's hop right into it. The first one that I want to talk about is in fact the most profitable one of the entire bunch, and it is the breakaway gap. The breakaway gap is a reversal gap, which means that it reverses a previous trend. The reason why this gap in particular is the most profitable is because it occurs at the beginning of a trend, meaning that the bulk of the move has not occurred yet. The size of the gap is proportionally correlated to the strength of the subsequent price move. What does that mean? The larger the gap, the greater supply and demand imbalance. Therefore, it gives the greater odds of the subsequent move having much more strength and breaking out from its trading range. With this gap in particular, what we want is a breakout that occurs on heavy volume. Ideally, this breakout establishes a new local high, meaning a new high within the last at least minimum of 20 days. If the gap is higher than the previous high of the last 4 weeks, that will be considered a very significant gap. To be noted when trading these gaps, if ever things don't go your way and the gap starts to get filled, that could potentially represent a moment to cut losses because the odds are that the gap is going to get filled. If ever you happen to hold a stock prior to it gapping, especially to the upside, the normal action to take in this case would often be to take profits, as being that most oftentimes these gaps eventually get filled. Unless, as I mentioned previously, there is a very strong confirmation for the breakout occurring on very high volume. With regards to downwards opening gaps, the dynamic isn't exactly the same as when it goes upwards because the odds of the gap filling when it is downwards are much less high, which is most likely a symptom of the fundamental reasons as to why the stock decided to gap down. Maybe a significant piece of news just came out indicating a more fundamental long-term change within the company. In any case, in terms of opening gaps, meaning gaps that occur from one trading day to the next, the general rule is that if the gap doesn't get filled within the first half hour of trading during that day, that the chances are that the trend will continue in the direction of that gap and that it actually won't end up getting filled. As with anything else in technical analysis, proper risk management is always key. And of course, none of what I say should be considered as financial advice. Any and all investment decision that you make is absolutely 100% your own. Alright, so let's move on to the next gap in the list, which is the runaway or / measuring gap. Unlike the breakaway gap, which marks a more definitive exit from a previous trading range, on one hand, the breakaway gap is the one that starts a new trend. On the other hand, the runaway gap actually continues that trend, especially when it's a trend that has a lot of strength behind it, or in other words, is going up with a lot of volume. Runaway gaps are often also called measuring gaps, as I mentioned previously, because they tend to occur at about the middle of a price run, meaning that the initial distance that occurs before the gap can be measured and projected above that gap in order to give the trader a price target. Unlike the breakaway gap, the runaway gap doesn't need to breach a major support or resistance level in order for it to be in play. The only criteria in this case is that it goes in the same direction as the overall trend. Unfortunately, as with anything in technical analysis, we can't take these gaps 100% for granted because runaway gaps generally display the exact same characteristics as exhaustion gaps, which are the third type of gaps that I wanted to talk about. So, contrary to runaway gaps, exhaustion gaps actually occur at the end of a move. This gap is caused by the final group of buyers who surge in all at the same time, leaving, once that's done, a smaller amount of buyers left over in order to sustain a further uptrend. So unfortunately, exhaustion gaps get filled very quickly. So with that being said, and of course, as with anything in technical analysis, proper risk management is absolutely key. It's really important to keep an eye on the strength of the trend. If, say, we were to see the exhaustion gap fill, especially on high volume, that would be an extra indication for any technical analyst that the trade is going to meaningfully reverse, at least for the time being. Alright, so the final and last gap that I want to talk about is the island reversal top or bottom. These, in a similar fashion to the exhaustion gap, are a type of reversal pattern, meaning that they reverse the trend. As we can see, we have a gap on the left and a gap on the right occurring just at around the same price levels, leaving a sort of island in between. These type of patterns generally occur after a relatively long-term trend. Between the left and right-hand side gap, what we generally see is a low amount of volatility, a low trading volume for many days, and it could even be weeks. And also what we usually see is volume increase upon completion of the second gap forming the island, especially when we're looking at an island top. The same is not necessarily true for an island bottom, but that's just a detail really. And for those who have been following very closely what I've been saying, the left-hand side gap can actually be considered an exhaustion gap, because it's the last gap before a reversal. And on the flip side, the right-hand side gap is in fact considered a breakaway gap, but to the downside, when speaking about island reversal tops, of course. And so all in all, the island reversal is in fact a combination of both of the gaps that I spoke about previously. Alright, so that pretty much covers the topic. If you found any value within this video, if you wouldn't mind just dropping a like for me, I would really appreciate that. If you're interested in learning much more about technical analysis, I have an entire series dedicated to the topic, so I'm going to put that link in the description below for you to check it out. That pretty much wraps it up for me. Thank you so much. I'll see you guys in the next one. Peace out.